Management fees are one of the most visible and negotiated components of a private fund's economics. Yet their accounting treatment, especially across different fund structures and life cycle stages, can be surprisingly nuanced. This article breaks down how management fees are handled in fund accounting, what fund professionals should watch for, and how service providers can support accurate, compliant reporting. What are management fees? Really, at their core, management fees are periodic payments made by the fund to the investment manager or general partner, GP, for overseeing the fund's operations and investments. These fees are typically calculated as a percentage of committed capital, invested capital, or net asset value, NAV, depending on the fund's stage and strategy. But in fund accounting, management fees aren't just a line item. They're a recurring transaction that affects capital account balances, expense allocations, fee offsets and clawbacks, investor reporting and transparency accounting treatment. Key considerations. Timing and accrual management fees are usually accrued monthly or quarterly, even if paid less frequently. Accurate accruals are essential for NAV calculations and investor statements. Misalignment between fee, accrual, and payment can distort fund performance metrics. Capital versus income treatment. Depending on the fund's structure and jurisdiction, management fees may be treated as capital-based deductions, reducing investor capital accounts, income statement expenses, impacting fund-level profitability. This distinction affects how fees are reported to investors and regulators and how they interact with tax allocations. Fee offsets and waivers. Many GPs agree to offset management fees against other income streams such as transaction fees, monitoring fees, or broken deal fees. These offsets must be tracked and applied consistently, often requiring custom accounting logic and investor-level transparency. Tiered and step-down structures, funds with tiered fee rates, e.g., declining percentages over time or based on AUM thresholds, require dynamic calculations. Accounting systems must be configured to handle these changes automatically or risk manual errors. Clawbacks and true-ups. In some cases, management fees may be subject to clawbacks or true-ups, especially if the fund underperforms or exits early. These adjustments must be reflected in both historical and current accounting records, often retroactively. Operational implications. Fund administrators and controllers should ensure fee schedules are clearly documented and reconciled to LPAs. Automated accruals match the fund's governing documents. Investor statements reflect net of fee performance. Audit trails exist for all fee offsets and adjustments. Final thoughts. Management fees may seem straightforward, but their accounting treatment is anything but. Fund professionals should treat fee accounting as a core operational discipline, not just a compliance checkbox. With the right systems, documentation, and service partners, funds can ensure accurate, transparent, and investor-aligned fee reporting.